What's on your mind?
Treacherous, that's the word. The environment of today is an awful environment. It's an awful environment for an investor. It's an awful environment for anyone that's trying to trade this market. The last couple of days, yes, there were opportunities as it relates to trading. There are certainly opportunities for long-term investors who do not believe that what the future will look like is going to look like something we saw in the 2000s when we had a lost decade. But what we are seeing today, when you have that 7% swing, when you've had the deleveraging that you've had over the last several days, what happens after that deleveraging? A lot of hedge funds, a lot of institutional speculators, they step to the sidelines. And what you're greeted with is a type of a market environment where you have today where you think you potentially get an all-clear signal, and then you're just whipsawing all over the place. So what do you do in that environment? I think you really have to study how much risk you have in equities and bonds and the totality of your portfolio. And if you're beyond the boundaries of where your comfort level is, I think you have to retreat on that because you cannot have strong conviction about either direction right now, given this treacherous environment.
All right. Tom Lee, we got Tariff Liberation Day wrong. You did. We want to apologize as the terms of Tariff Liberation Day. We got Tariff Liberation Day wrong. Yeah, you did. We want to apologize as the terms of Tariff Liberation Day were far worse than we expected. Morgan Stanley, be prepared for another 7 to 8% potential downside. Krinsky's talking about the 200-week moving average. That's 46.74 as being major support. Mike, I'm curious. You've seen so many markets and you've seen a lot of volatile markets over the course of your career. What do you make of this one and the way that we've had this price action today?
I think a lot of those folks who are trying to use whatever process to come up with some kind of structural, maybe we've done enough to the downside, it does settle out not too far below where the overnight futures were, like kind of 46, 47, 4,800. And that kind of takes you back to the beginning of 2022. And I think it is very relevant that we haven't seen this kind of intraday action since early 2020, because it is that kind of complete disjunction. Right? It was essentially the market was trying to handicap, a process. The process was completely thrown off by an off-the-charts, basically interruption in the world economy, and that's what happened in 2020. And then what you're left with is trying to figure out if we're getting to a level of being washed out to where it doesn't matter what the news is. We had the latest post from the president, people saying, wow, the market took it well, that he said another 50% on China. Well, one, that's a preposterous number. The market recognizes that once you're getting up to these levels, it doesn't matter. But also, he said, negotiations are happening with other countries. Do we care? Do we not care? Is it just the market reacting to itself right now?
Do we even believe it?
Right.
Because you get the narrative of the two sides of the story. Not negotiable, negotiable. He's going to negotiate. These aren't negotiating things. I mean, is it for revenue? You
have the billionaire backlash. That's new this week. You have this idea that maybe there'll be legal challenges to it. I think that there's a migration in sort of the center of opinion of how this might go out and how urgent the issue is. To me, I'm just watching the market and saying, looks like the equity futures made a triple bottom overnight. Use that as your downside kind of mental floor for the moment. It's like 48.50-ish. But I mean, it's so tenuous. And when the market's moving like this, I always say it has to just go really far to find anybody with conviction. And that's why you get, this type of twitchy action.
Pasquarello, Goldman Sachs, the fundamental backdrop has undeniably worsened, he says. Remember, he's the one a week ago was like preservation of capital, people. That's what this is about, that the game has changed. He follows it up with this most recent note. While the primary trend is now lower, I also think you have to be aware of the increased probability of indiscriminate short cycle rips. It's a feature, not an oddity, of when you have the S&P do this sort of thing. I expect the S&P will cut a broad pattern of gap down, gap up over the next few weeks. And the final point he reiterates, his view, preservation of capital, still the principal objective. My trading instinct, and it's nothing more than that, he says, is that next week brings some form of a de-escalation. You've had the headline that the market moved on. We're looking, Brian, for any signs of light. As many people I talked to yesterday, late into the night, were thinking that there's got to be some sort of pivot coming at some point because this is untenable, that they don't understand the damage that they are causing. if $11 trillion wiped out of stocks in a very short period of time doesn't ring the alarm bells, then something ultimately is going to do that. I'm frankly struck by the fact that you suggest today that you are staying the course, that you have 6,700 for the year on the S&P. I have countless targets taken down, more again today, 5,600, 5,200, 5,950 from various strategists respectively there. Why are you staying the course?
Well, first of all, we're excessively fortunate to be here today. We've had this opportunity over our career to be on this network during days like this, and I can't be more humble for that, number one. Number two, Joe used the term treacherous. I would say unfortunate. It's very unfortunate what's happening here because I don't think it is anything with respect to fundamentals. And as you know, we're a fundamental investor. I can't speak to other people's process or discipline, Scott, in terms of how they look at targets. I know that how we do. And my team and I spent the weekend writing 2 reports, one for the U.S. and one for Canada, as is our duties as the chief strategist at Piper. I'm sorry, Piper, at BMO. At the end of the day, it is excessively rare to have this type of activity 2 days in a row. It's not rare to see a Friday type of sell-off into the weekend and have the exacerbated bottom that Mike is talking about on a Monday. In fact, on Monday, March 20th, you and I were on the Markets and Turmoil show after the market closed on COVID. And at that day, I said the market's going to rally up 50%. And so I'm not being flippant. I'm not being stubbornly bullish. I believe in what the market is telling us historically. And since 1950, when you have these types of moves in these successive days, 12 months out, the market's up 29%. Now, does that mean that we're not going to see these exacerbated moves on a short-term basis? Nobody can predict those. Nobody can time those. But what we can predict is the fundamental backdrop. Longer term, near term, yes, we have some damage here, and we will assess that and assess our target once we know where the bottom is and when we begin to recover from that.
Okay. I want to take issue with one thing that you said.
Yep.
Aside from the confusing where you currently were. But that's neither here nor there. That's for you to reconcile, not me.
Better hope you still work there.
You make the claim that this is not due to fundamentals. I would make the argument that it is everything to do with fundamentals. Mm-hmm. Forget about the technical trading of levels here and there, averages, blah, blah, blah. This is obviously about the market sensing a recession and trying to right price itself for the recession that many now see as a higher probability. Many firms are obviously taking up their expectations of that. If you think that earnings are going to have to come down, which they will in a recession, and that the multiple will have to come down, which it will, then that is purely based on fundamental trading, not on anything else. That's what the market's trying to go through. Don't you agree?
Okay, so stocks lead earnings, which lead the economy. The stock market's telling you that we're probably going to have some sort of a slowdown and or a recession. Remember, when the recession, the Fed comes in and pumps in liquidity. The Fed pumps in liquidity. What are we going to do? We're going to buy stocks. So I think at some point we are going to have some sort of slowdown and the earnings are going to go down. We'll adjust our targets when we start to see some substantive proof of that.
What do you mean?
No, hold on a second. What's happening? Do you think that this rhetoric and change in tune and fake news and tariff stuff, do you think that has anything to do with how companies are going to be earning their money or how they're looking at going forward, how to model their company? How can they change on a daily or weekly basis when we don't know what we don't know?
You're telling me that companies haven't already changed their expectations for the kind of business and spending and investment that they're going to do? They all have.
Do you think
they all have?
Do you think the membership process in Costco has changed? Do you believe the way that the operating system runs Apple has changed? Do you believe that the internet machine at Google has changed? Do you believe that how Netflix and the way that they run their business has changed? No, the answer is no. Now, how they model that, how they grow that, how they operate that, yes, we know that, and that is going to change, and we will change our numbers accordingly when we see those real numbers, Scott. So I think from a longer-term perspective, we are investors. We're not going to react to today or last week or what Trump's going to say in 30 seconds. We don't know that because that's not fundamental. What Trump is saying is not fundamental with respect to his reaction, and how we're reacting is not fundamental.
Dow Jones down 0.6%. U.S. oil still taking a hit. That shows the economy is likely going to be in trouble in the near term. Gold is also retreating back, much to be expected after that blow off top. We'll see that chart later. And Bitcoin put in a daily low at 3 o'clock in the morning and lifted up all the rest of the cryptocurrencies quite nicely. So, but ultimately, we'll get into Bitcoin here in a minute too. All right, so into the spiders. We have the spiders displayed here. What we have happened recently has truly been phenomenal. I've never seen this before in my trading career, where we've had 3 consecutive river theories where we have traded down through this parallel, gap beneath it, then we gap beneath the next support, and then we gap beneath this support. And if I scroll back out on the chart, you can see where I'm getting these trend lines. Here was the 2021 high, and here was a 2022 low. We were gapping beneath all of these levels, and here's a pivot high from 24. But ultimately, notice the price action and behavior here into the 10-minute, where I show you what I was talking about earlier. We started selling off first thing in the morning. Then news came about potential relief of tariffs. And then boom, the markets went higher. And one thing that I've derived from this is you got to consider the markets and people are watching price action go down and down and down. All the while, we've been programmed to buy the dip. And so there's a lot of buyers on the sideline just waiting to get back into the market. Any bit of good news is going to drive the price of the stock market higher. So that showed me, case in point, exactly what people are waiting to do, but ultimately didn't materialize for a very big move of the day. Now on to Bitcoin. Bitcoin overnight at 3 o'clock hit my target zone, the $72,000 to $74,000 price range. It got down to $74,420. So at the end of the trading day today, if we remain in a doji situation like this, we likely are going to go up in the near term. And what do you mean by that, Drew? Well, what I mean is this whole setup is part of what I teach in the sleeper hold, mastering the overnight trade. It's a time count move down into support. With this sort of formation, we likely should see a little bit more of buying pressure with Bitcoin. First resistance was already tagged right around 81,000. If we get very bullish in the markets and there's tariff news of easing, we should push up to 87. And ultimately, the grand goal and biggest move for Bitcoin could be up here to 94,000. I don't anticipate that happening. Should selling pressure resume on Bitcoin, this target down here I have is about $61,000 on the chart. And it's very real and could be a possibility of getting there. All right, on to gold. Gold has, as you've seen, we've had a blow off top over the last week here with price action. Any bit of good news on the economy has sent the price of gold coming down. But really, actually, this was all technical analysis. When we have a move of this magnitude of gold moving up higher, it needs to cool off. First area of support is going to be right here under $3,000, $2,955, followed by $2,869. On to silver. Silver is, as I mentioned the other week, a little bit more of an industrial component, as this does follow. And there's a lot of technology pieces that have silver inside of them. So silver has fallen down and actually bounced up quite a lot today. And that's due to the economy potentially bottoming out. So I don't think the selling's over with by any stretch of the imagination. However, silver's getting a relief technical bounce, as you see here on the charts too. First resistance to get through is going to be this $30.41 area. But if selling resumes on silver, we could very potentially hit $25.17. Now on to oil. As I said, the oil looks, it kind of like the silver chart in that it tested the trend line that it just broke, but we didn't confirm price action underneath this trend line just yet. So this area is minor resistance on the charts. Should selling still continue on oil, there is a measured move down here to $53.15, which could actually happen. Natural gas is continuing its fall off after hitting this top end trend line and the 382 Fibonacci retrace. Support for natural gas is going to be here at $3.57, followed by this trend line at $3.43. Now into the Mag 7. Now this is really interesting, and we didn't have a positive day. However, we've had a change in character, the way this price action has behaved with all of these Mag 7 stocks. Now, if you notice here on Microsoft, we did gap lower, but we ran straight through a November 2021 high pivot, which you locate right here on the chart. You can see it right here. We didn't get quite down to this weekly 200 SMA, so that still will be support should price action come back down there. Now, in the very near term, should we have positive news come out about easing of tariffs, you can anticipate us going back, retesting this parallel, which already was tested. Parallels right at 366.86. Should we bust through that? 377.60 is the next target, followed by $400.48. Now into Google. Google, very much like the other Mag 7s, had a nice bounce up off of its lows. And this support trend line, if you see back on the chart, goes all the way back here until July of 2023. This is all technical analysis that guides us as to which direction these stocks are going to go. The main thing for Google, though, is to get through this declining trend line right here, which it looks like it closed right on today. First step, get above this area. And if we have any sort of relief and bounce, I think Google could go back up to 166.37. As a side note, too, why I talk about these Mag 7s, why I'm bringing them up today is a lot of folks are invested in these Mag 7s, and they're very important to understand and usually the first to catch a bounce once any sort of good news hits the markets. All right, into Meta. Meta, as you see, has had a nice cascading fall, breaking through these other trend lines of support. Now that we're beneath here and confirmed, these areas are now resistance going back up. So this is a $570 target here on Meta. If we get any more positive news, $590. Ultimately, if we get really good news, we could get all the way up to $663.01. However, that is doubtful. Into Nvidia. Nvidia has 3 different levels of resistance moving up into this parallel. Now, first step, much like the chart of Google and Microsoft, we need to get above this declining trend line. Have not yet accomplished that. Should that take place in the near future, immediate target on Nvidia is going to be $108.62. The ultimate destination, should we get a great bounce, is going to be the bottom end of this parallel, roughly around $120 on the chart. But all the while moving up, we should still have some pullbacks or pauses unless we just get a complete relief of all these tariffs. Now into Amazon. Amazon too fell down quite nicely today, but then it bounced up, closing higher than where we closed on Friday. This is a very positive close on Amazon in the near term. First up, resistance at 185.41, followed by busting out of this potential parallel right at the $200 mark. It's such a psychological number. I would anticipate, should price action move higher, there will be a lot of sellers that are holding Amazon when they held it all the way down, wanting to get out of their pain right around the $200 area. Now into Tesla, this one's a little bit different because it involves some political ties. And so Tesla, this chart reminds me so much of the way Meta looked back in the metaverse land. And I'll just scroll back over to Meta just to show you what I'm talking about. Here you could see price. Nobody wanted Meta down here at the end of 22. Mark Zuckerberg was investing in the metaverse. He thought this was going to be the next great thing. Nobody was really believing that he was putting so much money into this development, and price action came all the way down here. Nobody wanted it, but look at the move that occurred afterward. Again, these are vehicles. You got to take emotion out of the trade and understand the potential of the move of some of these Mag 7 stocks. So into Tesla, we have support here at 213.65 and it is trading above that now. But should selling pressure resume on Tesla, this area down beneath at 168.18 will be a fantastic accumulation area. Really, anything under $200 right in that zone would be ideal for buying Tesla and holding, because I think the potential for Tesla with their new robots coming out in the future are going to be game changing. So keep an eye out on buying levels here on Tesla in the near future. Up next is Apple. Apple, as you know, has been hit pretty hard with a threat of tariffs coming out of China. And as a lot of their components are made in China, assembled, here in the United States, but a lot of their phones, computers, etc., are made out of China. These tariffs are a serious threat for Apple. So back into the charts, Apple hasn't bounced as much as the other Mag 7 stocks have. And that's mainly due to the reason that I just explained. So if we were able to move up, the first resistance is $200 here on the chart. I do want to point that coming through this area, this measured move of 197.40, I highlighted that last Thursday, how Apple had more selling to go because of this measured move pattern off of the head and shoulders. We accomplished that feat. Now that feat's been accomplished, it's time for potentially a relief bounce. Watch this $200 area. If we get through that, the next stop is going to be $221.20. All right, so a lot of Mag 7 details that we just went over. Hope these levels help guide you in the future to make good trades. Mag 7 stocks, as I said, have a ton of investors in them. They don't want these stocks to go down so that all their clients and themselves can still retain profit. It's important to keep your eyes on these stocks moving forward.
Yeah, I mean, if we close here being down 0.6%, feels like we're flat on the session, to say the least here. I think the market's really trying to decide what the president's really going to say. He is actually making some remarks right now, so you're seeing a little bit of a holding pattern when it comes to the price action here. But if I'm kind of looking at going into the close, you have some pen risk at 5,000, at that 5,000 level. There's a significant amount of options positioning there just across all of the major expirations, a lot of the quarterlies, as well as even the April expiration that's going to expire next week. And so we might have a little bit of pen risk there. If we do get some positive energy to the market, so we try to bounce to the upside, I'm looking at 5,150 to around 5,200. We highlighted 5,200 earlier this morning. We broke through it briefly and then faded back, but that could be an area to the upside here. And into the downside, 4,950. You know, Caroline, the one thing that I would just put out there as far as risk, I mean, we had this announcement from President Trump, and he just confirmed it in this press conference right now regarding increasing those China tariffs by 50% if these retaliatory tariffs from China are not removed by tomorrow. And it doesn't appear that the market is really taking that threat too seriously. So that is actually a pretty really big potential downside risk, not only to equities, but also potentially a re-rating when it comes to yields here. So let's see how the market actually positions going into the close. We've been trying to push higher. Mega cap tech has been kind of leading the way anytime that we had this push to the upside here. But I would just put it on the radar for a lot of individuals. Next 24 to 48 hours, we actually have probably even bigger risk than the first China announcement that we had. If they do come back and retaliate again, the market is not pricing that in whatsoever.
All right, so I want to talk to you about what that could mean in terms of volatility and the VIX. I do want to just say I'm taking a look at the Reuters headlines from what President Trump is saying. And as you said, he did talk about China. He says, we will talk to China. I have a great relationship with Xi. Hope it stays that way. In terms of that 90-day pause, which they called fake news, according to CNBC, he did say we are not looking at a 90-day pause. And he also says tariffs could be permanent and could also be talks. So basically not learning a whole lot from here. So if it could be riskier over the next 2 days or so, what are we seeing in terms of volatility in the market, and what could we see?
Well, volatility, if you're looking at the VIX, is still elevated. We're still sitting at around a 47, about a 48 VIX. That's implying around a 3% intraday move to the upside or downside. And you're seeing that reflected also in the S&P options, not only on the wings, which is really what the VIX is being priced off of, but also when you're looking at the money calls and puts. And unfortunately, that is actually driving options volume on the index level. If you're looking at the NDX, if you're looking at the Russell or the S&P 500, to drop dramatically. Last time that I checked before coming on here, the top traded contract today is only sitting at around 39,000 contracts being traded. That's the 5,200 calls. Caroline, at this point in time, usually we're sitting at around 78,000, maybe even close to 100,000 contracts being traded. So you're seeing about half of that volume, even maybe 60%, 30% of the average volume that we usually see. So it will compress trading activity on the index level, but even though the individual equities, we're probably still seeing a lot of options flow that is there. But VIX is at a very extreme range. We're talking about a 6 to 7 standard deviation move to the upside. It can stay elevated for some time. Back in 2008, the VIX was elevated for almost a month and a half or so before actually moving back to the downside. But if you're a bull, you want to actually start seeing us incrementally moving lower here when it comes to the VIX, and hopefully that's going to provide equities a little bit more of a boost to the upside here. But if China does respond and they respond in a negative way, we could actually see a pretty significant blowout of the VIX to the upside. And I'm talking 60 level, 70 level type of blowout.
All right, we'll keep our eyes on that. Just should note that NASDAQ has turned positive. S&P 500 basically back at the flat line right now. Dow's still down about, call it 320 points right now. So anything else catching your eye as we head into the close?
Yeah, we look at the yield market. 10-year treasuries had a massive range today. If you're looking at the micro futures, we were trading down to around 3.82% to the high of around 4.21%. That's a very wide range when you're looking at the yield market in general. But you did see a backing off. Now, we need to see maybe a little bit more follow through over the next couple of sessions. Is this a backing off because risk is starting to be, are we starting to see more of a risk on tone? Are we selling out of treasuries, getting into equities? Or are we also kind of selling out of treasuries in preparation for some major auctions that we're going to have this week, the 10-year and 30-year auctions? And a lot of these foreign buyers, the ones that we're kind of having a trade dispute with, are major buyers when it comes to the treasury market. So that one's one to keep your eye out on. Intraday volatility, very, very high. This is probably one of the bigger moves that I've seen on a 24-hour basis for yields since I've been looking at markets, which has been over around 20 years now at this point. So keep your eye out on that. That could be your risk on. That could be a risk on type of indicator, or it could also indicate that maybe people don't want to get ahead of these auctions if they do become a little bit weak, or if they come in a little bit weak because of lack of foreign demand.
It doesn't really play into the recession narrative, though, or the whole Fed's going to cut 5 times this year narrative.
If yields go up?
Yeah, a 10-year yield ticking higher.
Yeah, well, I mean, it was an aggressive move to the downside. You're looking at around a 50% retracement from what we saw pretty much at the beginning of the month to the lows that we saw earlier this morning. So I would say that we're at a 50% retracement level. You don't want to see the 10-year go too much to the downside, while Fed fund futures are still sitting at around 4.25%, 4.5%, what have you, that range, because structurally it will actually create a liquidity drain in the debt markets. And that's one of the key areas that has not broken yet. We're seeing some fractures, but it hasn't broken yet. So you'd like to see actually some stability in yields and maybe maintaining around this 4%, 4.2%, instead of seeing a yield at 3.8 or 3.6%. Okay. That disconnect will be a major issue for credit markets over the next two to 3 weeks, actually.